Hi investors, I hope you're all doing well. In this video, we are going to talk about stock valuation. There are many different metrics that you could use to value a stock. They can reveal how a stock's valuation compared to its industry group or a benchmark like the S&P 500 index. This allows you to do an apple-to-apple comparison between companies of different sizes. Throughout this video, we will discuss basic metrics for stock valuation, including PE ratio or price to earning, PEG ratio or price to earning growth, PS ratio or price to sales, and gross profit margin. So I'm using FinViz here to quickly see how different companies compare to each other using different metrics. Let's say I use the PE ratio. The PE ratio or the price to earning ratio is one of the most widely used stock analysis tools used by investors for determining stock valuation. PE ratio is basically share price divided by earning per share. This tells you what investors are willing to pay based on earning. For example, here, software as a service companies have much higher PE ratio compared to companies in different sectors like in bank, for example. So why is that? So PE ratio doesn't tell you the full story because one company might worth paying more, in other words, higher PE ratio if their earning growth rate is higher. So when taking in earning growth into account, one would use PEG ratio or price to earning growth ratio. So let's use a simple example here of two companies with the same share price, company A and company B. So earning per share for company A is $5, while company B is $2.5. So the price to earning ratio is 100 divided by 5, which is 20 for company A, and 100 divided by 12.5, which is 40 for company B. So just looking at the PE ratio, company A might be considered undervalued just looking at the PE ratio compared to company B. But if you take a look at the earning growth rate, so company A here has 10% growth rate. This means the next year it is expected to grow earning per share by 10%, while company B will grow even more, which is 40%. So the price to earning growth rate ratio is for company A 20, the price to earning ratio, divided by 10, the earning growth rate, which is 2, and for company B is 40%. So the PE ratio is 40 divided by 40, then that means the PEG ratio is 1. So the common rule to evaluate PEG, a PEG ratio of 1 or lower suggests a stock is fairly priced or even undervalued, but a PEG ratio above 1 suggests a stock is overvalued. But this is not an absolute rule, just for guideline. Besides using stock screening tools like FinViz that we used earlier, you could go to financial website like Yahoo Finance and see this metric value and other related financial data. So all you have to do is go to statistic tabs. You can see all the metrics here, and as you can see, there is trailing 12 months which look at the company income over the last 12 months, and then there is also forward PE, which takes analyst estimate of earning for the upcoming year and uses that as the earning figure. While one gives you the actual performance, the other gives you the expected future performance. So forward PE will always be lower than trailing 12 months PE if the company is projected to grow even more. If you see PE ratio without specifying which type it is, you can assume that it is the trailing 12 months. So comparing companies in the same industry is very useful, but we also need to find out where a company is in their business life cycle to see when a metric is useful, but in certain cases it can be less relevant or even misleading. So take the two metrics that we discussed so far, PE ratio and PEG ratio. They are only useful if a company actually produces earnings. It doesn't mean, however, some companies that just started and are not profitable yet, not worth investing for. So now let's see which metrics are more relevant across company business life cycle. So across business life cycle, business go through different phases, and the first one is research and development. So in this phase, company comes up with an idea, and through research and development, they turn this concept or idea into real product or service. They may have a prototype, but it's not something that's ready to sell just yet. In this phase, there's no metric that you could use, really. It's more speculative and You are reliant on the company management to be able to bring their product or service to market. Usually the share price would be highly volatile depending on investor sentiments as more information becomes available. So sample companies would be QuantumScape or NanoX Imaging. So in the second phase, the company actually has a real product or service. Initially the sales are low, but slowly and hopefully steadily increasing. So in the launch phase, company may spend more on marketing or advertising, for example, to gain more market shares. And sales is initially low and the startup costs are high, and hence company in this phase don't have any earning and may appear to be burning cash. Since there's no earning yet, PE ratio doesn't make sense here. It's more useful to look at the price to sales ratio or PS ratio. So rather than defining the share price by the earning per share, we are using the sales or revenue per share here. So the next stage is growth. So in the growth phase, company experience rapid growth of sales, and as sales increase, business starts seeing profit as soon as they pass the break-even point. Profit cycles here still lags behind because the profit level is not as high as the sales. At this point, PE ratio can be very confusing because it's often astronomically high. For example, Tesla that currently have around 1100 trailing PE, compare that to BMW which has 15 trailing PE. In my opinion, it doesn't necessarily mean that Tesla is not worth investing because the two companies here are in different phase in their business life cycle. So another example here, let's have a look at PE ratio trend for Amazon from 2013 to now. So in 2013, it has around 1000 PE ratio, which is extremely high, but the chart shows how company could grow into its valuation. And since then, the share price has appreciated from 312 to almost 3,400 today. So going back to the business life cycle here, the company in the growth stage is optimizing itself for profit, but it's not yet there. The more relevant metric to look at rather than PE ratio is gross profit margin. It's one of the commonly used profitability ratio to gauge the degree to which a company or a business activity makes money. It represents what percentage of sales has turned into profit. Simply put, the percentage figure indicates how many cents of a profit the business has generated for each dollar of the sale. For instance, if a business reports that it has achieved a 30% profit margin, so it has a net income of 35 cents for each dollar of sales generated. Thus, a company with higher profit margin may deserve a higher valuation because they will produce more earning in the future. The next phase here is shakeout and maturity. So in this phase, sales continue to increase, but at a slower rate, usually to either approaching market saturation or entry of a new competitors in the market and so on. So sales peak during the shakeout, and although sales continue to increase, profits start to decrease in the shakeout phase. This growth in sales and decline in profit represent a significant increase in costs. As it enters maturity, profit margin also gets thinner. So during the shakeout and maturity phase, the PE and the PEG ratio are most relevant here. Companies in these stages are more mature, for example, Microsoft, Google, or Apple. So in this phase, one would continue investing if the company continue to grow or have another product or service to start another life cycle extension. So if the business is simply declining without a new source of earning or revenue, then the PE ratio will not be very useful here because at this point it's not worth investing. So dividend yield might look very high here because the share price is declining and the PE ratio might seem low. It doesn't mean that the stock is undervalued because if the earnings are heading towards zero, then those numbers are irrelevant. So we have looked at a few metrics for valuation and which one are relevant depending on the business life cycle. So it's more a hope or speculation during research and development. During the launch, because it's not profitable yet, it's useful to use price to sales ratio. And during growth, we want to see how company can increase its gross profit margin, and how sustainable is that? Is it fluctuate over time, and so on. And then once it's reached its maximum gross profit margin, then it is more mature, and we can use the PE or PEG ratio to value the stocks. And then after that, if the company is declining, then there's no metric that we could use, as we said earlier. So there are more sophisticated valuation metric, for example DCF or discounted cash flow, which usually involve a spreadsheet. However, using some of the basic metrics that we discussed, PS ratio, gross profit margin, PE and PEG ratio, you could already measure stock value and always consider where a company is in their business life cycle to see which metrics is more relevant. Hopefully this is useful, and good luck with your investment.